All right, welcome to another episode of the Wall Street Rundown. Welcome back, guys. I'm your host, Billy Clement. I got Wale with me. What's good, Wale?
How you doing, man?
Man, this market has been interesting. I don't know, man. Today was like, I don't know if you saw Tesla. Tesla ran up like crazy today.
There were so many bullish orders on Tesla yesterday.
Yeah,
Man, I thought there was they broke out some like new news or something like that because usually you don't see a move like that on Tesla unless there's like news or something. But man, what a move.
yeah, that was a crazy move, man. I was like, oh my God, what is happening? I mean, like we went from like consolidating to like bam, we just came out of nowhere, man. And just looking at the stock market, like it's interesting to me that like you see like some stock participate in 1 week, and then 2 weeks later, some stock start participating. So it's like, how do you how do you keep track of that? It's like you have to be in position at all times. You know what I mean? Like you always got to pay attention. So it's like whether you have a set of stock that you watch or a set of ETFs that you keep an eye on, so you kind of know
Yeah,
like, okay, this week they might be down, but maybe this is the time to start looking at it and start buying some more and stuff. So just understanding that, man.
yeah. Because there was a if you look, we caught a nice move today on Planeteer, and Planeteer for the last couple of days hasn't really done anything.
Nope.
I think yesterday it was like down 2%. And if you look at going back to what was that, 820, all that
Mm-hmm.
consolidation all the way
Mm-hmm.
until about 9-8, just nothing until it made its move today. So
Right.
yeah, you gotta keep your eye, you gotta keep your ears to the streets.
You have to, because otherwise, like that stock that you've been watching might run and you're not paying attention to it. You know what I mean? Or you just turn
Exactly.
around and be like, oh shoot, that thing just ran up and I wasn't paying attention to it. So set your levels accordingly. But overall, man, S&P gained about 0.3%, closing at a record high of 6,532.04 today. The Nasdaq also was a little flat. We didn't really go up too much today. It was about 0.03%. The Dow Jones was down. WM was doing some nice move yesterday. I was gonna keep an eye on it today. I was like, today maybe I can get like a quick move to the upside. Nah, man, that thing got smacked. But it didn't really go anywhere today.
And I thought small caps would have a better day today, but small
I
caps
thought
are
so too, man.
were
I thought
down
so too.
1%, but we'll get into that later.
Yeah, I even thought like maybe like yesterday. I thought the momentum kind of continued from yesterday, but it
Yeah,
just didn't, man. It
yeah.
just it just kind of fell flat. But this week, man, we saw like the stock market kind of move a little bit up because Oracle. I mean, again, we're going back to the Oracle move. Oracle moved like 35 to 36% in like in 1 day. That was nuts after they reported. You know what I mean? So again, that kind of helped kind of drive the market up a little bit. Inflation data, like we talked a little bit about PPI. PPI came for August and it came cooler than expected. You know, some people talk about maybe we don't have inflation, but I was like, hey, you better chill, man. We do have inflation. It's gonna come. We're gonna see it. You might not see it in all type of places, but we are gonna see it. But I guess PPI kind of made people more confident in the Fed kind of like cutting rates soon. I mean, I know we're gonna talk a little bit about this. It's gonna be 25, 50, 100. We don't know. You know what I mean? It's coming up in week, 2 weeks.
No, it's next week.
It's next
Wed-
week. So
Wednesday. Wednesday.
we have a big week next week. So we'll see what the Fed decides if they're gonna cut or not.
So the question I always have about this is when we go back to, remember when the market was up big that one Friday, maybe like 2 or 3 Fridays ago. I think it might have been like Jackson Hole or something like that.
Yep.
If we get a cut, is that already priced in where
It's
the
already
market
priced
may not
in.
react? That's the one thing I
Yeah.
have to I have to I have to be worried about. Now, I will say if the market is expecting 25 and we get like 50,
Mm-hmm.
then that might be a catalyst for the markets to actually start to move to the upside. But the one thing I'll say though, based on where rates are and based on where CPI is, and I know that the Fed likes to look at PCE rather than CPI when they look at
Yep.
their inflation gauge. Historically, as long as rates, the Fed funds rate is higher than the inflation percentage, then I think you're fine. Because I forget, there's a chart I looked at years ago, and I posted it before, where it compared the Fed funds rate to where CPI, I don't know if what CPI or PCE was and how they're kind of stacked. As long
Hmm.
as you don't cut under, so right now there's still room to cut. I think the Fed funds rate at what, 4.25?
Yep.
Yeah. So as long as we don't go below like, 3.5, like if you can probably cut to like 3.5, maybe even to possibly like, 3.5 and hold rates, and you probably may not see a lot of difference in inflation unless something drastically changes. But if things kind of remain where they are now, I think you got at least 75 to maybe 100 if you're pushing it in cuts, and then you can probably hold. So that's what I'm thinking the Fed is going to be looking at this week.
Yeah, but I mean, even with CPI, like I keep telling you, like that. I think I have the same sentiment I have for like the employment number. Now I'm
Hmm.
starting to have the same sentiment when it comes to CPI.
Mm.
Are the numbers being recorded accurate? Are we gonna? I don't know. Does CPI get revised numbers sometimes or no? Or is it like more solid?
Yeah, CPI doesn't really get, I don't think that it come out with revised numbers for CPI
Okay.
now. I know GDP gets revised, and I know that the jobs numbers get revised. Yeah.
Yeah, but I mean, if you look at the numbers, like food prices rose by 0.5% over the month over month
Hmm.
and 3.2% year over year, right? Energy was up. I mean, we know energy is always going up for some reason, but only 2.2% over the past year. So, you know, I think that's mainly due like the gas and all the stuff kind of like one
Hmm.
day is up, one day is down. So it's like kind of like, evens out a little bit. But shelter was up, and like I think that's probably the biggest contributor to CPI increase. Like housing and all this stuff is it's going up. It's not as cheap anymore. So again, I don't know, man. Like I feel like I have the same sentiment now about CPI the same way I have about unemployment numbers that we're talking about. So it's like
Mm.
some
Yeah.
some something's not adding up because if you go to the grocery store, you're feeling the pinch. You
Yeah.
know, if you go to fill up your gas, you're feeling the pinch. Your rent, your energy, all that stuff, you're feeling the pinch a little bit. So I mean, as long as we can afford to pay for those things, I don't think the government gonna care. But the
See that,
moment we can't afford to pay for it anymore, then it becomes a problem.
and that's why I think the Fed is going to focus on the jobs numbers, because the thing is, as long as people have jobs, they will be able to hopefully maintain their standard of living.
Yeah.
So if they start to lose their jobs, then that becomes a bigger problem. So are things more expensive? I would 100% agree that they are. But as long as people are employed and are able to meet their financial obligations, to me, that might be a little bit more important than trying to,
Mm-hmm.
you know,
Mm-hmm.
trying to, curb inflation, the inflation side. I think that the inflation side of their mandate, the employment side of their mandate, to me, I think takes precedence over everything. And you can tell that, there's inflation because, man, did you see what happened with Restoration Hardware after they reported? I think they were down like
Way.
17%. I think they recovered, but yeah, they took a
Ooh.
pretty big hit today. So
Yeah.
they were,
Yeah.
yeah.
So,
So
something's happening in the background. Like, you know what I mean? Again, like, do you take those numbers and take it as truth? I don't think you should. I think you should be cautious about it. I think the market still hasn't factored in the inflation. I mean, the market been running. Like maybe we see like a couple of stocks here and there, sectors here and there that kind of dropping, but the overall market is still up. Like look at S&P, look at ES,
yeah.
like look at Nasdaq. Like we are still we just hit an all-time high. Like you know what I mean? So it's like we still haven't really like grasped the hold of like talk about tariffs, we talk about CPI, we talk about inflation and all this. Like we haven't grasped like the intensity or the overall breadth of the whole thing.
So the reason I'll say that the market continues to run, I always say this, that it's earnings that drive markets. And if you take the market as a whole, I would split it into two pieces.
Mm-hmm.
Businesses are getting more efficient and are posting good earnings. Consumers, not so much.
Right.
So that's the way I would look at the market. It's bifurcated into the B2B and the B2C. If you're looking at like retail goods, you're looking at, consumer spending and consumer consumption. Those things, I think you have to be real selective of where you invest in that
Yep.
category.
Yep.
But when you look at B2B, with businesses doing business with other businesses, especially for the need for AI, software, and all that stuff, those companies are the ones that are really still doing well and posting good numbers because even with our inflation, even with where rates are, I mean, Oracle's guidance was crazy,
Yeah. Yeah.
crazy. To put up that kind of guidance in a market where people are saying, "Oh, we may have a recession," eh, I don't know about all that. I
Yeah.
think the consumer is where a lot of people are sort of feeling the pain. And if you're looking at investing in businesses that are heavily reliant on consumers, then you might have some issues. But if you're looking at businesses that are reliant on just other businesses, I think that's a safer play to be in this market, in my humble opinion.
Yeah. Yeah.
Yeah.
Absolutely. And for those of you who are probably wondering what Oracle guidance was, Oracle predicted for fiscal year 2026, their cloud infrastructure, which is they refer to as OCI, their revenue to grow by 77% in 2026. I
And we're
mean,
talking we're talking about Oracle, not a
oh,
startup. We're talking about Oracle.
we're talking about like a solid company that's saying like, listen,
Yes,
we have 77% to grow. Like that is
that's
crazy.
crazy. And it would not surprise me because here's the thing. If Oracle can hit those metrics, right? They could go on the same kind of run Nvidia went on a couple years ago.
Yep.
Like it's possible.
Yeah.
Because if you guide that high and you're able to deliver, oh boy.
Everybody will want a piece of you.
Everybody's going to
Everybody
want a
want a
piece of
piece
you.
of you. Yes.
Exactly, exactly, and
Yes.
they're tiptoeing on the doorstep of becoming the next $1 trillion company. So,
Ooh. I mean, for a company like that, I used to work at Oracle. I just let you guys know. I used
oh
to work for
really?
Oracle. Yes.
Okay, okay,
I used to work for Oracle. And back in the day, they were like, they were like the giant, but they were like really slow moving giant. You know what I mean?
yeah.
But the way they're moving now, like they have their hands in all different sectors, healthcare, finance, all like infrastructure, like all of that stuff, retail. You talk about hospitality, they have their hands in all of those different things. Cause I was part of that like time when they were just buying different companies, right? So the company I used to work for, they bought it and then it became
Mm,
Oracle and stuff. So
gotcha, gotcha.
yeah. So yeah, man, they're definitely everywhere, So hey, they're doing the right moves, Like you said, they might be on a run just like in video was, and we'll probably be sitting here talking about when they hit $1,000. I don't know. We'll see.
Yeah, we'll see. But I like what I like what I see with what they're guiding. But I will also say this though: if they miss,
If you miss,
yeah,
your ass coming down.
you're
But
gonna
I
get
mean,
punished.
you have to be really confident to say something like that. Like
Oh
you
yeah,
have to really know in the books, you have some of those deals already in the books.
in
So
the pipeline. Yeah, yeah.
you already know like you book at least that amount and more going into 2026. You know what I mean? Like you cannot just throw these numbers out there just because you feel like it. So that's crazy. That's crazy. So moving on, like 20, we talked about a lot of IPOs. I was kind of shocked that we didn't see a lot of IPOs or mergers still yet, you know what I mean? But it looks like as of early September 2025, there'll be like about 230 plus IPOs. Maybe like we haven't been paying attention to what kind
So
of
a
IPOs.
lot of the ones that have gone public have been pretty small. So what
Yep.
I've seen is that you're getting more IPOs, but the amount of money being raised on these IPOs hasn't been super big,
Mm,
right? So most of the names that have come out, like we got Klarna, we got Figma went public, you got Circle, you've got CoreWeave. Um, who else do you got? I think
Gemini.
Gemini went public today, the cryptocurrency company, and then
I
the
think
other
I
one.
think we have Stripe and Discord actually trying to go. They're trying to go public in 2026. So I don't
Okay.
know.
Yeah. So, because remember, during I mean, a couple years ago, we weren't seeing no IPOs,
Nope.
no mergers and
They put a
acquisitions.
stop to that thing.
Yeah, that thing was not happening for a while. And then I think we did talk about this going in with the new administration that more people would be more open to doing more mergers and doing more
Yep. Yep.
IPOs.
Yep.
So I'm, I'm thinking that some of these like investment banks like KKR, Goldman Sachs, JP Morgan, I think when they start reporting their numbers, I'm pretty sure their investment banking business is going to start reporting better numbers now that IPOs, because they're the ones that handle all these deals. They're going to be, in the putting down those numbers and showing people that hey, we've got some activity in the IPO market. So
Yep. Yep. Yep.
Yeah, finally getting some. Yeah, I haven't bought any new IPOs this year though. I've been sitting on my hands. So, but I'll be looking. I like Figma. Figma is one I'm looking at. It almost got to 50, but it didn't. It's kind of been floating around between 50 and 53. So I'll be taking a look at them. I miss CoreWeave completely, and Circle I have not
Man,
touched.
Coral Reef's another one, man.
Yeah,
What's happening with Circle? I haven't really been paying attention to what happened with
yeah,
Circle.
Circle's come down from this high. I think it hit a high of 298, and now it's
Ooh,
at 125.
that's some
One,
crazy drop.
yeah, it took a huge drop. Took a huge drop. I'm not really in tune to their business model as much as I am into someone like CoreWeave. Like
Yeah.
I know CoreWeave's business model. I kind of know what they do, and they're in the AI space. Some of these crypto plays, I'm not saying I don't know. I'm not saying that they're bad businesses. It's just that I think they're just so heavily reliant on number of transactions that
Hmm,
happen.
hmm.
I mean, I don't know. I'm probably missing something. It's not the space that I know very, very well, but yeah, at coming from 298 to 125, maybe it becomes a little bit attractive, but
Yeah.
I still like CoreWeave. Speaking of CoreWeave, there was a big trade on CoreWeave Leaps for next September at the like 170 strike
Next year?
next year. So I saw an order today. So
175. Ooh,
let me see what
that's a
strike
big
price was
number.
this. Yeah, let me look at the premium real quick. So this was a oh not 170, I'm sorry, 130 strike. So yeah, $11.6 million buy for CoreWeave Leaps going to September 2026.
Interesting. When are they reporting? I mean, they might be
Yeah,
speculating on reporting and stuff.
yeah, let me see. But to me, I don't know why they would go out all the way to 2026. But yeah, I don't see anything in CoreWeave's pipeline when they're going to report next yet. Actually, I
But
think a potential date is
they're
November
buying.
13th.
Yep, they're buying time.
Yeah.
Yeah,
So
buying time. That's not a bad. That's man.
yeah, but
That is not a bad.
CoreWeave is also in the short squeeze.
Yeah, that's what I was gonna say. Like that's not a bad one to keep an eye on as we
Yeah.
get closer to
Yeah.
November and stuff.
It retested 108 today.
Fill that gap too.
Yeah, retested 108 today. I think I would be looking at an entry anywhere above 113.20 to 115.
Yeah, it filled that gap, the last gap for
Yeah.
this run. So
And you can kind of see it's kind of formed a flag.
yep.
Yeah. I would put CoreWeave on my list of potential tradable positions next week. Kind of
Yeah, I
like
heard it here first. Put
I
that
would
on your list. I'm dead
I would
serious too.
I
Like
would
put
put
that on
that
your
on your
list.
list. Yep. So
So yeah. But yeah, man. So as we move to next week with potentially Fed rate and Fed cutting rates and all these different things, the Russell 2000. I mean, we saw some good gain this week. Like it's up about 9% since August 1st. So it's like it's moving pretty nicely. You know what I
we're getting
mean?
close to that high.
We're getting really close to that high. So I mean, this rally is kind of fueled by like potentially the rate the Fed's cutting rates sooner, which turns into lower borrowing costs, which tend to help small caps, more than large caps. So I mean, we're seeing some really really good moves from IWM. Go look at the IWM chart. You're gonna be like, whoa, how did I miss that move? But let's get your feedback on that, man, because it's like I think it's still in the air, right? Like, is it 0.25? Is it 0.50? I mean, we saw some numbers up there. It might be like even 0.100. But I think if we get anything over 0.25, we might get a rally. I know you said like it might be already be kind of like factored in,
Yeah.
but what number? Is it at 0.25 or 0.50? You know what I mean? So I think if we get anything over 0.25, I think we're gonna see the market go crazy.
Yeah. And what I'm looking for again, when I'm looking at the broader market, because when we keep looking at um, which indexes are making new highs, it's usually QQQ, SPY, QQQ, SPY. I know SPY is the index that represents the whole market, but remember that it's heavily weighted towards large cap tech companies.
Yep.
So Nvidia, Microsoft, Apple, Amazon, Google, Tesla, Facebook. those are the names that are mostly going to drive the performance of SPY,
Yep.
period.
Yep.
So the RSP is the equal weight, and that has made a new high yesterday at 190, but it hasn't been with the same sort of momentum as the other indexes, right? IWM also hasn't made a new high. So to me, I feel there's a lot of opportunity there, and
Mhm.
IWM is playing catch up.
Yep.
If you're
Big time.
patient, yeah, if you're patient, to me, IWM, when we start getting rate cuts, because I think that the high is what, 244?
Yep.
244, yeah. And we're at 240, so we're getting close. I still feel like IWM is playing catch up.
Mhm.
So,
And if we break that high, it's going to be a lot of buying coming too.
yeah,
Once we break that new high, I think it's going to be a lot of buyings coming. So,
yeah. I'll be paying attention to small caps when we get our rate cut because I feel like if the Fed sounds very optimistic about cutting, comfortable with cutting, I think IWM is going to be one of your bigger winners. Now, it may not happen right away. I'll say
right,
that. It may not happen right
right,
away,
right.
but I think eventually you'll see small caps start to make their run. So we'll see what happens.
Keep an eye on that. With that being said, man, let's move on to our financial Fridays. I know you said you have a couple of tips to give how to pick funds in your employee retirement account. I'm actually very interested in that because I'm managing my own account and stuff, so it's like I'm
Okay.
always curious to know like what else I can do better, man. Cause I want to get those 200 percentage in there. So so I'll turn it over to you, man, and let's give it to the people.
All right, man. Let me get my setup going. So everybody to me who doesn't plan on working for the rest of their life probably allocates some aspect of their money into their employer sponsored retirement plan, right? A lot of times what happens is you get your employer sponsored retirement plan, right? And then you just get a list of funds and they're just like, pick. A lot of times, I'll be honest with you, HR folks are not going to be the ones that are going to help you pick the right funds. Sometimes if you have a retirement plan through your employer that's run by Fidelity, I will say Fidelity is one of the better institutions that if you call the 800 number, you can get some pretty good guidance. Vanguard's another one that's also good at that. I'd say those are the top two when it comes to actual customer service. When you call the 800 number, you can actually get real guidance. But to me, it's not really that hard when it comes to looking at funds. And I just want to draw your attention to a couple of metrics to take a look at when you're looking at, okay, there's like two large cap funds, there's like three small cap funds, there's like two international funds. How do I pick the best fund? So let me walk you through a process of what you need to be looking for to pick funds that are attractive. All right. So we are sharing right now. So let me say this first. So if you are fairly young, you're not close to retirement, maybe, the earliest age you can start taking money out of your employer sponsored retirement account without any penalties is 59 and a half. So if you're 20 years, I'd say anywhere between 18 or more years away from that date, your portfolio should be heavily weighted towards equities. Even if you're someone who says, I'm risk averse, I don't like losing money, guess what? You can't touch that money anyway. So being growth oriented in the early days is going to help you long term. So keep that in mind. The younger you are, the more opportunity you have for growth. To me, the more aggressive your portfolio should be. Number two, to me, you should focus on three main asset classes: large cap, small cap, and international. Those should be now how you divide the pie up into those three areas, completely up to you. But to me, those should be the top three asset classes that you should be a part of. I'd stay away from bonds if you're young. If you're a little bit older and approaching retirement, maybe you want to add bonds to your portfolio. But as long as you have those three covered in your portfolio, you should be okay. Mid cap, I'm a little bit iffy on. If you miss the mid cap boat, to me, that's like a to me that's like a hit or miss category. And if you cover small caps and you cover mid caps, to me, if you blend them, I mean, small caps and large caps, to me, if you blend them together, you probably have the same risk allocation as if you've added mid cap. So that's why I just kind of like, okay, if you see mid cap, I probably wouldn't opt for that. Now, what to look for in a fund? Manager tenure to me is very, very important. Now, sometimes in your employer sponsored plan, the ticker symbols that they give you aren't going to be what you can research online. So that you might have to actually find the name of the fund and then go research that fund yourself because the ticker symbols might be a little bit different. In some cases, you might actually find the real ticker symbol. So, if you can, good. But sometimes sometimes for large employers, they get like custom symbols that are not really tradable on the mutual fund system. They're just specific to that employer plan. So look at manager tenure, and all of this data is available to you through your employer. They should be available to you. If it's not, you might want to call a lawyer and file a lawsuit. So manager tenure is important. I would opt to look at funds that have at least 10 years of data. And the reason for that is that's typically a full market cycle. That's a full round trip. How did that manager do? Funds that don't have that much data, I'm not saying that they're bad, but you want to look at something that has a lot of data that you can look at that you can compare it. Also look at, does the manager's investment style deviate from the core fund objective? So if this is a large cap growth fund, right? How often does the manager deviate maybe into large cap value, right? Does he stay with his lane when it comes to large cap growth? That's something that you can look at. If you go to morningstar.com, they have what's called a style box. And if there's a lot of style drift, it'll tell you. And I think I can probably show you guys what that looks like. Cost. Any fund that has an expense ratio of 1%, I would avoid it. Now, you may not now, if you have a small employer, like let's just say your total aggregate portfolio in your employer plan is like less than $5 million. You might have some high cost funds in there, but I would still stay away from anything above 1%. I would just invest in an index. Index funds are going to be very, very cheap. So if you have a small plan, like you work for a small employer, maybe it's only like 8, 10 people and they offer a 401k, or the aggregate size of the plan is very small, just look for index options. If you don't have index options, that's a problem. Probably want to find a lawyer and sue your company, because index options should always be available in 401k, 403b plans. Avoid funds that carry front end sales load. You're probably not going to find that in retirement plans anymore. Those are things that have kind of changed over the last couple of years. So funds that charge you a fee to get in, those things are probably gone. Fund history and data. So focus on the 5-year and 10-year data, right? The 1 year and the 3-year data, they may post it, but to me, that's not what I want to see. I want to see the 5-year and the 10-year data, because again, remember, this is a long-term investment. You want to know what manager performance looks like over a full market cycle. This doesn't really apply to the index, because if you're just buying the index, right, the manager is not really managing the funds. They're just mimicking what the market looks like. So with indexes, you just want to make sure that the index you're buying pretty much matches the index of the S&P 500 or the NASDAQ or IWM, et cetera. And as long as those performance don't deviate too much, then you should be fine. Avoid active funds that perform below their category average. So active funds tend to carry more fees, right? Because there's a lot of trading that goes on in those funds. You're buying an active fund that has small performance compared to the average, its category average, I would avoid that, because what's happening? Fees are just eating up your returns. So therefore, if you see an active fund that doesn't necessarily beat the benchmark or has a very, very low ranking in its category average, I would avoid it altogether. All right, so let's look at some data points that will help you sort of narrow down what you should be looking for. To me, the most important metric is alpha. Alpha basically measures a fund manager's value. Better or higher alpha is better, because basically what it's telling you is alpha measures risk-adjusted returns, right? And what it's saying is, as I'm taking more risk, am I being compensated along that journey? In any investment philosophy, obviously, if you're going to take more risk, you want to be paid for it, right? So therefore, you want to look at alpha. Alpha will give you that metric and say, as I move on the risk level in this portfolio, as a fund manager continues to take on a little bit more risk, no matter how incremental, am I being compensated? Alpha will give you that number, and I've given two examples of that in the in this slide. Beta beta basically just measures correlation with the overall market. So usually betas of 1 or higher are gonna correlate to the market a little bit more. Betas lower than 1 are gonna be a little bit less correlated with the market, which means it's gonna take less risk than the overall market. So that's something that we'll take a look at, and I'll give you an example with the funds that I posted here. R squared, that's basically looking at correlation to the index. So this is one thing I will tell you. Correlation, so any active managers who have high R squares, we call them closet indexers. So they're charging you active fees, but they're basically just mimicking the index. Be very, very cautious of those types of managers, because if you're just going to mirror the index and charge me a higher fee, I'm just going to buy the index and pay way less in fees. So be very, very, very cautious of closet indexers, because those things, again, you're going to be paying for higher fees, but you're just going to be buying the index. So be mindful of that. Sharpe ratio is another measurement of risk-adjusted returns. So again, the higher the Sharpe ratio, the better. And then standard deviation. Standard deviation is a measure of volatility. Typically, what that means is if you have higher standard deviation, that means there's going to be a lot more variability in the returns when you look at the mean average return. So that's something to keep in mind. So I gave you two examples here. One is an American Funds Growth Fund of America, and another one is a Vanguard Growth Index Admiral. So these are both in the large cap growth category. Morningstar has ranked these. I don't read too much into the Morningstar ranking like the stars. I mean, that kind of helps you. It's a good starting point, but that's not the tell all be all, because a 5-star fund or a 4-star fund may not always be better than a 3-star fund in all cases. So this is the process I would look at. Start with alpha, right? So we're looking at alpha on a 10-year basis. The Vanguard Growth Index Fund has an alpha of 1.78. That's really, really good. You compare that to the American Funds Growth Fund of America, which I think is an active fund, that has an alpha of 0.85. So you've got better alpha with the index compared to the American fund. Beta of 1 compared to a beta of 1.04. Now, the growth fund index, the Vanguard fund, takes on a little bit more risk than the overall market, because that 0.04 basically means it's higher than the overall volatility or the overall risk in the market. But even though it's higher, what am I going to say? I'm going to say, look, I'm being compensated for that, because if you look at the alpha, it's 1.78. The American fund has the same beta as the overall market. It has positive alpha of 0.85, but I'm not compensated for it as much if you compare it to the Vanguard fund. R squared, 94.2, that's okay. I'm not really concerned about that. When you start seeing like 98, 99, 97, then I'd be concerned that this is a closet indexer. 94, pretty good. Sharpe ratio, another measurement of risk-adjusted returns, 14.49 compared to 14.10. Now, usually if you see a higher beta, you typically might also see a higher standard deviation, which again, because higher beta means I'm more riskier than the overall market. Higher standard deviation means that I have a little bit more variability in my returns over time. But again, when I look at the alpha, I'm being compensated for taking on additional risk. So that's the process I would look at when you're looking at, comparing funds. You can dive into fees and all that stuff. So, just, keep that in mind. Now, another question that some people will run into is, does passive investing always outperform active? And the answer to that is it depends. It depends. It really does depend based on manager style. So what I did is I found an active fund, which is labeled APGXY, and I compared that to VIGAX, which is an index fund, right? And I just looked at the 10-year comparison. These numbers have not been updated. But I think if you look at the analyst rating, this goes back to about 2020. I'll probably look at this and see if there's been any changes. But let's just say this is back in 2020 and I'm looking at these two funds and I'm like, okay, this is an active fund. Fees are a little bit higher. Does it make sense to pay for the higher fees compared to an index fund? So let's look at the alpha, 3.78. That is amazing. So if I'm looking at a actively managed fund that has higher fees than an index fund, and I see alpha of 3.78 over 10 years, I would be very, very happy about that. Because again, I am being highly compensated for taking on additional risk in this portfolio and paying higher fees. The beta is also actually lower, which is very rare. But if I'm able to get higher alpha with also taking less risk in the overall market, to me, that's a win-win. You those That's very rare to find, but you do have those in certain cases because sometimes if managers make really, really good picks and they concentrate on those picks, like let's say a manager that had Planeteer or a manager that had Nvidia over the last couple of years, they've probably got really, really, really good alpha in their portfolio. R squared. Okay, this has an R squared below 90. So this is not a closet indexer. This is a fund manager that does not mirror the index that much and is actually selecting the funds appropriately to drive performance is why you see higher alpha. Sharp ratio is also good, and standard deviation is also lower. So this is a fund manager that knows how to pick stocks very, very well. So if I had this fund in my retirement plan and I compared it to um, an index that was also my retirement plan, 10 times out of 10, I would go with this fund. So that's the process to kind of go through. Again, the biggest metrics that I would say pay attention to, there's probably a lot more you can look at, but alpha, beta, R squared, Sharpe ratio, standard deviation. Those are the five things you want to be analyzing over a long-term period to kind of start comparing funds to see which ones are good and which ones are not so good. So, and if you look at the performance between the index and the active fund, I think I got that on the next slide, you can see that there's a $5,000 difference over that 10-year period. So this is going back from 2010 to 2020. You can see that being on the active side over time has actually proved a little bit better than being on the passive side. So that's it.
No, that was good, man. I think the other question I have is, some people always say like, should I go with a professional people to manage my account for me, or should I do it myself? Like in that case, like what do you recommend? When should a person consider like, okay, I'm ready to like, do the research myself and be able to kind of select my own funds and all these different things versus like, hey, this is too complicated for me. I'm just gonna let somebody else do it.
I'll say that it depends on who you go with because I know some advisors who are kind of like, if you ain't got $1 million, I won't even talk to you.
Mm,
So, it depends on where you go. So this is the rule of thumb. If the money is still sitting in your employer plan, in most cases, the advisor is not they don't have jurisdiction in that realm.
right, right.
You're probably just going to have to call the 800 number and they're probably going to have to give you guidance. If it's like in an IRA, typically once you start getting over like the 500,000, $600,000 range, that might be where you start wanting to get professional management if you don't
Mm,
have the time. The reason why I say that is at 500 or 600,000, let's just say we're in a bad market cycle. A 10% drop is like 50 G's. It's a
yep,
lot of money.
yep.
That's a lot of money to see go down. You know, you got $100,000 account, 10% drop is like 10 grand. That doesn't really move the needle as far
Right.
as maybe affecting your lifestyle down the road. Once you start getting to higher numbers like 800,000, a million, right? A 10% drop, like that's basically like a market correction. That's 100 grand. That's
That's
gone.
gone. Yep.
That's potentially a year's worth of income in retirement. That's gone.
Mm-hmm.
So once you start to get to those levels of assets, you don't have the time to do the research or you just don't want to. That to me is where professional management starts to become more important. But while you're in the accumulation phase and the money is still sitting at your employer, you can book a consultation with somebody like me and I can just kind of guide you through the process. You don't have to pay an annual fee for it. You just need someone to kind of direct you. How should I be allocated? Do these funds look good? Things like that. And I can, walk you through the process. And I can usually do that in like 1 or 2 meetings rather than you having to pay like an annual management fee. That's just
Yep.
me. Yeah.
Yep. So you guys heard it, man. Hit up Wale if you need guidance.
Yeah. Because this is stuff that I've done because I've actually, so another thing I'll also say too is if your employer actually has an advisor assigned to your plan, call the advisor.
That's what they
Call
get
the
paid for.
advisor.
That's what they're
Yeah,
getting
that's what
paid
they
for.
get paid for,
Yeah.
right? Because some advisors, they sit on these plans and they never come and talk to the employees. They just manage the plan.
Yep.
I worked for a company where we would go in at least every 6 months to every single retirement plan that we managed. They would see us and we would say, we're going to be here from like 1 to 5, book a one-on-one for a 30-minute or 20-minute slot. If you have a large enough plan, like let's say it's 10 million, 15 million, 20 million, just say your plan's pretty big, chances are you might have an advisor assigned to your plan.
Mhm.
So if you do, reach out to the advisor because that's exactly what they get paid for.
Yep.
So, and there's fiduciaries. So they're supposed to do what's in your best interest as well. Don't go to HR. I'll tell you
So
that. But
HR probably point you right back to them. So
correct. HR is probably going to tell you call the advisor. So if you
right.
have an advisor assigned to your plan, call the advisor.
Yep.
Um,
Yep.
and if you don't, call me.
There you go. There you go.
Yeah,
But yeah, but I think people should really pay attention to, like, if you have a 401k or a Roth or whatever, it's like you got to pay attention to those things. Like, either you seek help or you seek education. Like either one of those. Like either you
exactly.
educate yourself on how to manage it yourself, or
Yep.
seek help. And eventually, if you pay attention, you probably can manage it yourself too. But
Yeah.
in any case, you can't just let it sit there. You have to have some type of help. So
And I'll say when you're in the accumulation phase where you're still building your portfolio, trying to get to that, let's just call it $1 million number, whatever. Don't overcomplicate the process.
mhm.
Don't overcomplicate the process. And to me, if you don't know what to do and if it's too much and you're just like, I don't know, you're better off just buy the index and just sit there.
Yep.
Just buy the index. You'll be fine if you just buy the index, right? So some companies now, what's very common is what's called target date funds. Like if you don't do anything, you're just going to default to a target date funds. I'm not against target date funds, but the thing is, sometimes I feel like I don't like target date funds that have bonds in them. If there are bonds in your
Mm,
in your target date fund, even if it's like 5%, to me, I don't think you need bonds in your portfolio until you start getting closer, to the age where you're actually going to need to start taking the money out. And
right.
that to me is like if you're about I'd take 10 years or less. If you're more than 20 years away from taking the money out of your retirement plan, stick to equities, man. That's my take.
Yep. Yep.
So
Well, that does it for Financial Fridays, man. That was good. I hope you guys are paying attention. I think it's gonna help a lot, especially if you like trying to figure out what to do with your 401k or your Roth. I think it's gonna help a lot. Um, Next week, man, we have the Fed meeting coming up. I think, did it start on the 16th or the 17th?
starts on the 16th, the Fed decision's on the 17th.
Yep. So
Yeah.
that's a major event for the week, man. So we'll see. We're gonna get 25, 50 more. I mean, that's gonna drive the market a little bit, depending on which one we get. I think if we get 25, I think it's already factored in. I don't think we're gonna go anywhere. But I think if you get 50 or more, I think we're definitely gonna jump a little bit.
Yeah. 50, I think 50 would be crazy.
Yeah, yeah. But I don't know, man. We'll see what Jerome we'll see what Jerome and his people do, but we'll see, man. It looks like we also have some retail.
Retail sales, I think, on Tuesday.
Yeah. So we'll see how the retail people do. I don't know, man. Yeah. I'm curious to see what the number is gonna look like. People still out here shopping, or where they're shopping at. So, and then we have I think we have inflation and outlook risk indicators. I think that's coming up on when is coming up. I think it's on Friday. No, there's nothing on Friday. So Thursday, we have Philadelphia Fed manufacturing survey and weekly economic index on Thursday. So we'll see. I don't know how much more is that gonna affect the market, but we shall see. Oh, new construction on Wednesday. We got to keep an eye on that one too. See how many new homes are being built and all that stuff. So that's going to be something to keep an eye on. But other than the Feds, I don't think we have any major stuff going on next week.
Yeah, the Fed is
Um,
the Fed is the big one. That's
yep,
the big one.
that's gonna. I don't know, man. Like you say, things might be already be factored in, maybe already priced in the move that we saw this week. I don't know. We'll see. We'll see how the market reacts when the Fed talk and all this stuff. So we might even not see the move that on Wednesday. Maybe we'll see it the next day.
Yeah, that's true.
Yeah,
That is true.
yeah. But yeah, other than that, man, any advice going into next week, even like the end of this month, man. Like this is the beginning of fourth quarter. Yeah, beginning of fourth quarter. Like, what do you think going on at the end of the month? And I haven't seen one thing people have been talking about is like September is a major month for like a pullback and all these different things. I haven't really seen that in the broad market,
Nope.
you know?
I think everybody looks at seasonality and says September is kind of like the one of the worst
Yeah.
months of the year historically. I don't read too much into that, even though I kind of get it. But you also have to understand that every year the market dynamics are different.
It changes.
It changes every single year. So um, I will also say one thing as well that I want to take a look at is I was trying to see what happened with rates today on the long end of the curve.
Mm.
Let me see. What did TLT do? TLT, yeah, TLT was slightly up today. You gotta hammer that close on the daily. It's off the high from yesterday, but there's a lot of momentum behind TLT right now. And I remember when I was making my TLT trade last year, I was thinking that this was the type of move I was expecting.
Mm.
TLT's gone from 86, actually a low of like 85 to like 89 in the last couple of days. That's a pretty big move for
That's a big
TLT.
move. That's a
Yeah.
big move.
So when we start getting to the one thing I'll be looking at is does the 10-year get below 4% when the
Mm.
Fed announces? If it starts to drift below 4%, to me, that's going to be a good sign. That could be a good sign that stocks might start to really start to move. So
Yep.
I'll look at the also too. Remember, I said always look at spreads between corporates and treasuries. Those three items that I talked about on the Fred app. Look at those numbers, and as long as they kind of remain stable, I think we're Gucci. So yeah, looking forward to Wednesday. But yeah, I'm betting that if we get 25, we may not see a move right away, but if we get 50, could see some action.
We're probably gonna see some action. Yeah, absolutely. But another thing I was gonna tell you guys, like, uh, if you go to ChatGPT, you can literally run a scanner on ChatGPT, which is crazy, man. I just discovered this today. I didn't even know that you can actually run a scanner on ChatGPT. Ask it like, can you give me like a list of like stocks that are below 50-day moving average, or 100-day moving average, or 200-day moving average, or stock that hits like 2020 low, like it will go and run all the scam fees. Like it, yo, I'm telling you, like this thing made so much, like it made it so much easy for all of us, like so I'm about to have fun with this. I'm
Yeah,
gonna
Chat GPT has really helped with when it comes to looking and digging for data.
man, it's
It has
amazing.
really, really helped because one of the things that I used to have to do back in the day when I would want to invest in like a company that's IPOing, I would read the S1,
Mm-hmm.
and that's a couple hundred pages.
Yep.
Like when I was looking to short Snap back in 2017, I read their entire
The
S1,
whole
which is
thing.
what gave me the confidence to short it.
That's
And that
crazy.
took me like it took me forever.
Yeah. Now you can just
Now,
summarize it.
now I can say, okay, the S1's been filed. Here are the things I want to see in the S1 that you want to look at. And then boom.
Yep.
So
Yep. So utilize those tools, y'all. I'm telling you, utilize those tools. I mean, you still want to fact check it. You still want to go into your chart and see exactly what he's saying, but
Correct.
I'm telling you,
Yeah.
man, it makes research a lot easier for you. You have no excuse, like literally no excuse to not be able to do certain things. You know what I mean? So
Yeah.
yeah, man. But other than that, I don't have anything else. It's a wrap for us. I hope you guys have a good weekend. Please don't forget to share, subscribe, comment, let the people know where we at. If you guys have any questions, please send us a message on Instagram. We'll definitely be there to be able to answer those questions. But other than that, man, we hope you guys have a good weekend.
Oh, one more thing. I just
Yeah,
saw APLD is up 38% in 1 week.
and we
Did
talked
we
about it.
did we find another hidden gem?
I'm
Only time
telling
will
you.
tell. Only
I'm
time
telling
will
you.
tell. But
I'm telling you.
I didn't know it was up that much this week.
Yeah, yeah. It literally I think it hit like a 2 year high. So it broke through January 2023 high. It broke through January 24 high. I mean 2024 high. I think we're going back to like that 2020. Yeah, we're going back to the beginning of the year high. So it's
Yeah.
it's it's moving, man. We're going back to 2022 high actually.
Yeah.
That's the next level.
It was a $13 stock about five
Mm-hmm.
days ago. Now it's at
Mm-hmm.
18.
Yep.
I don't know if we found another gem, but I'll be watching.
I
And
think we did. I
and
think we did.
Aklo just crossed $80 again. So hopefully we can get to that 90 mark.
I think we found the base. I think the base right now is like around $70. I think
Okay,
that's every time we drop to there, you guys better
let me
get in
see.
there.
Yeah, the one thing I've been looking at with Aklo is that if you look at every time it pulls back, it makes a higher low.
Hmm.
So if you look at the pullback we saw back in
Yep.
June compared to the pullback that we saw in July, higher low.
Higher lows.
Then
Yep.
another pullback in July, higher low.
Yep.
Then another pullback in August, higher low. And then
Yep.
another pullback in September, higher low. So
Yep.
I'm thinking we could see this thing hit 90 pretty soon. So
Yeah. We're heading to take that 85 high real soon.
yeah. So
So yeah, man. APLD. I'm telling y'all, keep an eye on that one. Keep
yeah.
an eye on that
But I
one.
will say it's gonna be a ball. It's gonna be a. It's not. It's gonna be a bumpy ride. It will be a bumpy ride. Any
Yep.
company that's really not profitable like that, that doesn't have gross profit margins in the positive, expect a bumpy ride. But
Yep.
opportunity, opportunity.
Hey man, you see what happened with
We'll
with
see what
Aklo.
happens. Yeah.
All right, y'all. Well, you guys have a good night, and we'll see you guys next week.
All right. Take care, everyone.
Eats. Have a good weekend.